welcome to a new ATFX video. My name is Gonzalo Canete and I'm here one more time to give you a quick fresh update of the most important events of this week. In this occasion, actually, we're going to talk about the central banks. There is three big central banks getting ready to modify the interest rates this week, and obviously it's going to affect the markets. We are share with you the charts and the most important points in relation with macroeconomic and monetary policies in a minute. But before we start, let me set the screen and remind you that if you are not subscribed to our channel, this is the right moment to click on subscription. Also click on the bell to receive notifications anytime we update these kind of topics and give you new content regarding what is going on. 4 points I want to share with you, which is mainly Central Bank of Europe. That was last week. We are going to review what was the most important things to highlight from Central Bank of Europe. Spoiler, nothing really was impacting the market from that perspective because it was already discounted. Central Bank of Europe was about to cut the interest rate. We have seen certain movements in dollar since then, but it's more related with the declaration of Christine Lagarde after the interest rate cuts, which is well, I will give you all details in the presentation, so no worries. First point, Central Bank of Europe and European economy. Interest rate cuts. We have seen last week how the European Bank cut the interest rate. We are now in a 3.65, if I'm not wrong. But again, it was following with the policy of the cut the interest rates, which is something needed in European Union considering the situation of European economy. I mentioned few micro data. Last one, the most freshly macroeconomical data from Europe, which is France monthly inflation is to 0.5 versus the 0.6 expectations. Eurozone industrial production weakness less than expected to a minus 0.3%. In any case, I have been mentioned this in our previous reports. Low inflation in Europe is not necessarily a good thing because it could be actually one of the symptoms of a recession. If the economy is not progressing in Europe, therefore there is no room to inflation to grow because simply the transactions are not happening. Demand is getting weaker, consumption is getting weaker, and therefore the industrial production, the growth rate, and everything is slowing down, and therefore inflation also is slowing down. That's my perception in terms of Europe, and that's why European inflation rate has been dropping. Outlook, don't want trajectory pretty obvious. That's what Christine Lagarde called pretty obvious, the trajectory of the monetary policy in Europe, but no firm commitments. She didn't mention if the next month we're gonna see an interest rate cuts again before the end of the year. And this is very interesting because I believe the lack of commitment from Christine Lagarde on the last speech from Central Bank of Europe is exactly the reason that has been pushing up the euro against the dollar and weakening the dollar in the last few days, few hours. And that's the only reason, I believe, because otherwise European economy is getting weaker and US economy is getting stronger, and therefore the capital should move from euro to dollar, changing the euro-dollar perception. You will see in the charts that what I'm saying right now in middle term make a lot of sense, but I will share with you all details in a minute. Traders scale it back bets on October cut 20% due to the unclear outlook and lingering inflation pressures. Core inflation in Europe is 2.8. I bring to you last week also the data with the charts. It's still 2.8, so it's closer to 3% than 2% target, even when the standard inflation is dropping below 2%, for example, in Germany, which is 1.9%. Still, the core inflation is 2.8% in Germany, 2.8% for European area too, and therefore inflation is still there, is still sticky, is what the Americans, US, they call sticky inflation, and it's still happening. Now, in terms of Federal Reserve, getting ready for this week, Wednesday, rate cut expectations, widely expected to cut the rates for the first time over the 3 years. More cuts since has likely in the coming months. So the expectation is continuous cut interest rates in the coming months. And I told you in the previous reports, and I say one more time, the only issue with this cut of interest rates is if it's going to be 25 basic points or it's going to be 50 basic points. That's the only debate. If it's 25 basic points, maybe the reaction of the market is that the cut is actually weak and they were expecting higher cut, like 50 basic points instead of 25, and therefore maybe the equity market could react negatively. But we will see that by Wednesday. Risk. Aggressive cuts could signal more worry than warranted. Debate on optimal pace and total size of cuts need to address inflation and job market. Which means if they, by any chance, and we have seen this in the market report, labor report published from August, from July on August. On August, we have seen how the unemployment rate was rising to 4.2%. Non-farm payrolls were lower, much lower than expected, 80,000, just to have in consideration. And in that case, the reaction to the market was actually not good. So I have been repeating to you this in many previous reports. Weakness in US economy is actually positive for equity market because it's discounted that Federal Reserve will activate the stimulus on the financial markets to prevent any recession in terms of labor market and so on, and also because, as they say in the previous monetary conference, they are more concerned now about the labor market than the inflation per se. Okay, good. If that's true, they should cut the interest rates because they have seen how the labor market was getting weaker. But not in the last report from August, which it was in that case little bit more in line with expectations, and also the core inflation rising just little bit, the PCA inflation, okay? So again, they maybe got the chance that they are not cutting the interest rates in the way that they was expecting. And I'm just to share and start with the charts, share with you this chart. As you can see, we can see euro dollar moving up the last few hours since last week, moving up above the level of 1.1125 right now. I got the feeling that in this case, we could expect in short term over this week, movements pulling down the relation of euro dollar. Even in long term, we got also the dollar index. We can see that it's making a strong support in the area of 100 points. And we have seen this already 1, 2, 3, 4 times. That's why I believe what we could expect is actually the dollar index rising back again, at least one figure, trying to go to 101 points, 102 points almost if it's reaching this other level. And therefore, is a dollar getting strength instead of a dollar getting weaker after this week. Let's see if these charts are actually resisting those levels of 100 points in dollar index, DXY. In that case, we probably will see that movement downturn in the euro dollar and rise on dollar index, which is also going to move the rest of the page, which is cable, British pound, and dollar yen. Now, going to the Bank of England expectations, we expect the interest rate cuts also in Bank of England. Markets, Bank of England cut another 1.25% by early 2026. That's the expectation, which is 125 basic points. The economic growth quarter by quarter was good. Q1, Q2 was higher than expected. But if you go to the monthly growth rate of the UK economy, you can see it's flat for the last couple of months. And therefore, that's why I believe the Bank of England probably need to cut the interest rates. And the relation on cable, the one you got in the screen, should be shorted also, should be a downturn and twist the market in that position. British pound in super long term since 2008, as you can see, is also downtrend, and therefore I believe we could expect again a strength in the dollar and weakness in euro and pound. And last for the last one, which is the Bank of Japan, we have seen how this is very interesting. The last few hours, Minister of Economy Sane Takaichi advocates for maintain ultra low interest rates. Bank of Japan Governor Kazuo Ueda indicates readiness for further rate hikes, and inflation remains around 2%, which it was 2.8% core inflation in Tokyo, if I'm not wrong. More 2.9%. Market expectation, most analysts expect another rate hikes this year, likely in December. Economic recover. Weak economic recover necessitates low interest rates. This is the main case I was explaining to you in previous reports. This is the end of the road. Japan needs to cut the interest rates if they want to keep the economy floating up, but they also need to increase the interest rates if they want to be sure that the yen is resistant and inflation is not an issue anymore. And as you can see, it was crazy the move we have seen in dollar yen the last couple of months. We also mentioned this move in advance in our previous reports, And as you can see in short term, we also see in the area of 140, 138 yens per dollar, yen, 140, 138, strong support that maybe could cause another rally, moving the dollar yen up to a new top levels. Okay, let's follow this up in the coming reports. And again, if you like this report, click on subscribe, click on the bell, and see you in the coming markets reports. Take care. Bye bye.